I'm George Soros. I've been analyzing political crises and their investment implications for over 70 years, and I'm worth about $7 billion. People always ask me how I read breaking news events and turn them into investment opportunities. They want to know how I analyze political chaos, economic collapse, and social upheaval to identify where capital will flow next. Well, right now we have a perfect case study unfolding in real time, the Venezuela crisis. Without taking any political sides or making predictions about specific outcomes, I want to show you exactly how I would analyze this situation using the principles that have guided my investment decisions for 7 decades. This isn't about Venezuela specifically. This is about understanding how any political crisis creates investment opportunities if you know what patterns to look for. The same framework I used when the Soviet Union collapsed, when the Asian financial crisis hit, when the European debt crisis unfolded. Here's what most investors miss. They see political chaos as something to avoid, something that creates only risk. But I've learned that the greatest opportunities arise precisely when conventional wisdom tells you to stay away, when everyone is selling in panic, when uncertainty is at its peak, when the future seems completely unpredictable. That's when wealth transfers from the emotional to the analytical. The Venezuela situation demonstrates every single principle I've developed about crisis investing. Currency collapse, political transition, resource reallocation, reflexivity dynamics, it's all there if you understand how to read the patterns. Today, I want to walk you through exactly how I would analyze this crisis, not to make specific predictions or recommendations, but to teach you the framework for thinking about any political upheaval from an investment perspective. Because here's the uncomfortable truth that most people don't want to acknowledge. Every political crisis creates winners and losers on a massive scale. Resources don't disappear during crisis, they get redistributed. The question isn't whether there will be opportunities, but whether you'll have the analytical tools to recognize them when they appear. This framework has nothing to do with politics and everything to do with understanding how markets react to uncertainty, how capital flows during transitions, and how perception shapes reality in ways that create massive mispricings. So let me show you how a crisis investor reads events like these and why political chaos often creates the greatest wealth-building opportunities of a generation. Historical context, learning from Iraq and Libya transition. To understand how to analyze the Venezuela situation, we need to examine similar historical patterns. I've witnessed several major political transitions involving oil-rich nations, and the investment patterns that emerge are remarkably consistent. When Saddam Hussein's regime fell in Iraq in 2003, most investors saw only chaos and uncertainty. The immediate aftermath was indeed chaotic. Insurgency, sectarian violence, destroyed infrastructure. But those who understood the long-term implications of political transition in a resource-rich nation positioned themselves for extraordinary opportunities. The key insight was recognizing that Iraq possessed the world's second-largest proven oil reserves, but decades of sanctions and mismanagement had left production capacity severely underdeveloped. The political transition, despite its violence and uncertainty, would eventually lead to massive infrastructure investment and production capacity expansion. International oil service companies like Halliburton, Schlumberger, and Baker Hughes saw their contracts and revenues multiply as reconstruction efforts began. But the real money was made by those who positioned early in Kurdish regional development, where political stability emerged first and foreign investment was most welcomed. The pattern repeated in Libya during the 2011 transition. When Gaddafi's government collapsed, oil production dropped to near zero, and most international companies evacuated their personnel. The immediate response from financial markets was panic selling of any Libya-exposed assets. But again, those who understood the underlying dynamics recognized that Libya had Africa's largest proven oil reserves and some of the lowest production costs globally. The political transition, however chaotic initially, would eventually restore production with modern technology and international partnerships that had been impossible under the previous regime. European energy companies like Eni, Total, and Shell, which had maintained relationships with various opposition groups, were positioned to benefit enormously from new concession arrangements. The key was understanding that resource wealth doesn't disappear during political transitions. It gets redistributed under new management structures. Now, looking at Venezuela through this historical lens, we see similar underlying dynamics. Venezuela possesses the world's largest proven oil reserves, but production has collapsed under economic mismanagement and international sanctions. Any political transition that leads to sanctions relief and foreign investment would likely trigger a massive reconstruction and modernization effort. The difference is that Venezuela's crisis has been longer and deeper than either Iraq or Libya experienced. Oil infrastructure has deteriorated more severely, brain drain has been more extensive, and economic collapse has been more complete. This means both the risks and potential returns are amplified compared to previous cases, applying reflexivity theory to political transitions. My theory of reflexivity, that market perceptions shape reality, which in turn shapes market perceptions, is particularly relevant during political crises because conventional analysis often breaks down entirely. In Venezuela's case, we have a perfect example of reflexive dynamics at work. International sanctions and political isolation created economic collapse, which created social instability, which justified further sanctions and isolation. This negative feedback loop pushed the situation far beyond what fundamental economic factors alone would have created. But reflexivity works in both directions. Just as negative perceptions can create downward spirals that exceed rational expectations, positive perceptions during political transitions can create upward spirals that generate enormous returns for early investors. The key is identifying when the reflexive cycle is reaching an extreme that becomes unsustainable. In Venezuela's case, the combination of complete economic collapse, massive emigration, and social breakdown created conditions that were mathematically impossible to sustain indefinitely. When reflexive cycles reach these extremes, they become vulnerable to sudden reversals, triggered by relatively small changes in perception or policy. A shift in US policy, international recognition of political change, or even credible signals about future policy direction can trigger massive capital flows as investors position for the inevitable reversal. Historical precedent suggests that when resource-rich nations experience political transitions after extended periods of isolation and economic collapse, the snapback effect in asset prices and economic activity can be dramatic. Iraq's economy grew 56% in 2004. Libya's oil production tripled within 2 years of political transition. The reflexivity principle tells us to watch for early signals that international perception is shifting. These signals often appear months before obvious fundamental changes occur, creating opportunities for those who understand how perception drives reality in politically sensitive situations. Understanding petrol market dynamics during political transitions, oil markets provide a particularly clear lens for analyzing political transitions because petroleum is both a global commodity and a geopolitical asset. The patterns that emerge during political crises in oil-producing nations are remarkably consistent and predictable. First, there's always an immediate risk premium built into oil prices when political instability threatens major producing regions. During the Iraq invasion, oil prices spiked 40% in anticipation of supply disruptions. During the Libya crisis, Brent crude jumped $20 per barrel, despite Libya representing only 2% of global production. But here's what most people miss. The risk premium usually exceeds the actual supply impact, creating opportunities for those who can distinguish between perceived risk and real risk. Libya's oil production was offline for months, but global inventories remained adequate, and Saudi Arabia increased production to offset the shortfall. The real opportunity in oil markets during political transitions comes from understanding the longer-term supply dynamics rather than the short-term volatility. When a major producer is politically isolated or economically collapsed, their production capacity degrades over time. Modern oil fields require continuous investment in technology, infrastructure, and human capital. Venezuela demonstrates this perfectly. Their production peaked at 3.5 million barrels per day in the 1990s, but has collapsed to below 800,000 barrels per day today. This isn't just due to sanctions, it's due to systematic underinvestment, brain drain, and infrastructure decay that compounds over time. However, Venezuela's oil reserves are so vast, and their production costs are so low that any credible political transition involving sanctions relief would likely attract massive international investment. Countries like Russia, China, Iran, and Turkey have already positioned themselves for potential opportunities, despite current restrictions. The historical pattern suggests that oil-rich nations experiencing political transitions often see production capacity increase beyond pre-crisis levels within 5 to 10 years, as international investment brings modern technology and management practices that were previously unavailable. For crisis investors, this creates a classic asymmetric opportunity: massive downside protection from the underlying resource wealth, combined with enormous upside potential from production capacity, expansion, and international market reintegration. But timing is crucial. The opportunity is largest when political transition appears possible but not yet certain, and when asset prices still reflect maximum pessimism about future prospects. Once transition becomes obvious, much of the opportunity has already been priced in. Capital flow patterns during regime changes. Understanding how international capital moves during political transitions is essential for crisis investing, because capital flows often precede and sometimes even drive political changes rather than simply responding to them. During regime changes in resource-rich nations, capital typically moves in three distinct phases, each creating different types of investment opportunities for those who understand the pattern. Phase 1 is capital flight and asset liquidation. Domestic capital flees to safe havens. International investors exit existing positions, and asset prices collapse below any reasonable fundamental valuation. This creates opportunities for those with strong risk tolerance and long-time horizons to acquire assets at distressed prices. In Iraq, shares of regional banks and telecommunications companies traded at 5–10% of their pre-crisis values, despite maintaining significant underlying assets and market positions. In Libya, international oil company shareholdings in Libyan ventures were written down to zero, despite the underlying reserves remaining intact. Phase 2 is selective repositioning as political outcomes become clearer. Sophisticated international investors begin establishing positions while uncertainty remains high, but credible signals about future policy direction emerge. This is typically when the highest returns are generated, because you're still buying at distressed prices, but with greater clarity about probable outcomes. The key during Phase 2 is identifying which international players have the best political relationships with emerging leadership structures and which domestic assets are most likely to benefit from policy changes. In Iraq, companies with Kurdish regional relationships generated much higher returns than those focused on central government partnerships. Phase 3 is the mainstream capital influx. Once political transition is complete and new policy frameworks are established, returns during this phase are typically strong but not extraordinary, because much of the opportunity has been recognized and priced in. The Venezuela situation appears to be transitioning from Phase 1 to Phase 2, with increased international attention and potential policy changes, creating early signals about future direction. But the outcome remains uncertain enough that asset prices still reflect maximum pessimism. Historical analysis suggests that the highest returns during political transitions accrue to those who can accurately identify the transition from Phase 1 to Phase 2 and position themselves accordingly. This requires monitoring political developments, international policy signals, and early indicators of capital flow direction. Risk assessment framework for political crisis investing. Crisis investing in politically unstable situations requires a completely different risk assessment framework than traditional investment analysis, because standard financial metrics become largely irrelevant during periods of regime change. Instead of focusing on conventional financial ratios or economic indicators, crisis investors must evaluate political risk, policy risk, execution risk, and timing risk as primary factors determining investment success or failure. Political risk assessment focuses on the probability of different outcome scenarios and their respective implications for asset values. In Venezuela's case, this means analyzing the likelihood of various political transition scenarios and their potential impact on international sanctions, property rights, and foreign investment policies. The key is developing probabilistic assessments rather than binary predictions. Instead of predicting exactly what will happen, successful crisis investors assign probabilities to different scenarios and position themselves to benefit from multiple possible outcomes while limiting exposure to catastrophic risks. Policy risk assessment examines how different political outcomes might affect specific sectors, assets, or investment structures. Changes in government often bring dramatic policy shifts that can make certain investments enormously profitable while destroying others completely. In resource-rich nations experiencing political transitions, policy changes typically focus on foreign investment frameworks, taxation structures, environmental regulations, and international partnership arrangements. Understanding which assets benefit from likely policy changes is crucial for successful positioning. Execution risk focuses on the practical challenges of implementing investment strategies during periods of political instability. Even correct analysis about political and policy outcomes can fail to generate returns if investment execution is impossible due to market closures, currency restrictions, or security concerns. This is why crisis investors often prefer indirect exposure through international companies with strong operational capabilities rather than direct local investments that may be difficult to execute or exit during turbulent periods. Timing risk is perhaps the most critical factor because political transitions are notoriously difficult to predict with precision. Correct analysis about long-term outcomes can still generate losses if investment timing is wrong, particularly when using leverage or short-term instruments. The solution is typically to build positions gradually over time, rather than making large, concentrated bets based on specific timing predictions. This approach allows investors to benefit from correct directional analysis while minimizing the impact of timing errors. Investment opportunity identification principle. Identifying specific investment opportunities during political crisis requires looking beyond obvious plays to understand second-order and third-order effects that create mispricings in related assets and markets. Most investors focus on the direct impacts of political change: oil companies in oil-rich nations, banks in financial centers, infrastructure companies in reconstruction scenarios. But the largest opportunities often exist in less obvious connections that sophisticated investors overlook during periods of maximum uncertainty. During the Iraq transition, some of the highest returns came from Turkish construction companies that secured major rebuilding contracts, Lebanese banks that financed regional trade, and Jordanian logistics companies that became key supply routes. These connections weren't obvious during the initial crisis, but became enormously valuable as reconstruction efforts expanded. Similarly, during Libya's transition, European refineries that had been configured for Libyan crude grades benefited enormously when production resumed. Maritime shipping companies gained from increased Mediterranean activity, and North African regional banks expanded operations as economic activity normalized. In Venezuela's case, similar second-order opportunities might include Colombian border region development, Caribbean shipping and logistics, regional banking expansion, and energy infrastructure serving neighboring markets. These opportunities are less obvious than direct Venezuelan exposure, but potentially more accessible to international investors. The principle is to identify assets and markets that would benefit from Venezuelan economic normalization without requiring direct Venezuelan political exposure. This approach provides upside participation while limiting political and execution risks. Another key principle is focusing on assets with strong downside protection that can generate positive returns even if political transition takes longer than expected or follows unexpected paths. Resource-related investments, infrastructure assets, and regional market leaders often provide this characteristic during crisis periods. The goal is creating portfolios that benefit significantly from positive political outcomes, while remaining viable even if those outcomes are delayed or modified substantially. This asymmetric risk-reward profile is the hallmark of successful crisis investing strategies. Timeline and staging analysis. Understanding the typical timeline and staging of political transitions is crucial for optimizing investment timing and position sizing during crisis situations. Historical analysis shows that political transitions in resource-rich nations follow reasonably predictable phases, each creating different opportunity sets. The immediate crisis phase typically lasts 3 to 12 months and is characterized by maximum uncertainty, capital flight, and asset price collapse. Investment opportunities during this phase require high risk tolerance and long time horizons, but can generate the highest returns. The stabilization phase usually emerges 6 to 18 months after initial crisis and involves gradual clarity about political outcomes, selective international engagement, and early signs of economic normalization. This phase often provides the best risk-adjusted returns as uncertainty diminishes while prices remain depressed. The reconstruction phase typically begins 1 to 3 years after political transition and involves major infrastructure investment, policy framework establishment, and broader international participation. Returns during this phase are typically strong, but more widely recognized. The normalization phase occurs 3 to 7 years after transition and represents full reintegration into international markets with established policy frameworks and restored international confidence. Returns during this phase approximate normal market conditions. Venezuela's timeline has been extended compared to historical precedent due to the depth of economic collapse and the complexity of international sanctions. But the same phases will likely occur, potentially compressed into a shorter time frame due to the severity of current conditions. The staging approach involves building positions gradually across multiple phases rather than concentrating investments at any single point. This allows investors to benefit from correct directional analysis while managing timing and execution risks effectively. Position sizing should typically start small during maximum uncertainty phases and increase as clarity improves and risk-adjusted opportunities become more favorable. This approach maximizes returns while limiting catastrophic loss potential, reflexivity, and market psychology during crisis. The psychological dynamics of political crises create reflexive feedback loops that often push asset prices far beyond what fundamental analysis alone would suggest, creating enormous opportunities for those who understand crowd psychology. During political crisis, fear becomes the dominant emotion, driving investor behavior, leading to indiscriminate selling that creates mispricings in assets with different risk profiles and fundamental characteristics. This fear-driven selling often creates opportunities in assets that are only tangentially related to the political situation, but become caught in broad-based liquidation. Conversely, when political transitions show early signs of positive resolution, hope and greed can drive prices well above fundamental values as investors rush to capture recovery opportunities. Understanding these psychological cycles allows sophisticated investors to buy fear and sell hope rather than following crowd emotions. The Venezuela situation demonstrates classic crisis psychology, with years of negative news flow creating deeply ingrained pessimism that may not adjust quickly to changing political realities. This psychological overhang often creates opportunities when objective conditions improve faster than investor sentiment. Historical precedents suggest that political crisis resolution often creates euphoric periods where asset prices overshoot fundamental values in the opposite direction. Successful crisis investors prepare to take profits during these euphoric phases rather than holding positions indefinitely. The key insight is that markets are driven by human psychology rather than pure fundamental analysis, particularly during periods of extreme stress and uncertainty. Understanding and profiting from these psychological patterns is often more important than precise fundamental analysis during crisis periods. Risk management and position construction. Crisis investing requires specialized risk management approaches because traditional portfolio theory assumptions break down during periods of extreme political and economic instability. Diversification across uncorrelated assets becomes crucial, but correlation structures change dramatically during crises as seemingly unrelated investments begin moving together. Geographic diversification, sector diversification, and instrument diversification all become important for managing concentration risk. Liquidity management becomes critical because market access can disappear suddenly during political transitions. Maintaining adequate liquid reserves and avoiding excessive leverage ensures that temporary market closures or restrictions don't force portfolio liquidation at unfavorable prices. Hedging strategies must account for the possibility that normal hedging relationships break down during extreme events. Currency hedging, in particular, becomes complex when dealing with countries experiencing political transitions and potential exchange rate regime changes. Position sizing should reflect the high uncertainty environment through smaller individual positions and longer time horizons. The goal is creating portfolios that can survive multiple adverse outcomes while capturing upside from positive scenarios. Framework summary and investment implication. The crisis investing framework I've developed through decades of experience analyzing political transitions provides a systematic approach to identifying and capitalizing on opportunities created by apparent chaos and uncertainty. The key principles are: understand that political crises create wealth transfers rather than wealth destruction. Recognize that perception often diverges dramatically from reality during periods of maximum uncertainty. Focus on asymmetric opportunities with limited downside and substantial upside potential. And maintain patience and discipline despite social and media pressure to react emotionally. Applied to the Venezuela situation, this framework suggests monitoring for early signs of political transition, identifying assets with Venezuelan exposure, trading at distressed valuations, and positioning for eventual economic normalization and international reintegration. But remember, crisis investing involves substantial risks that are unsuitable for most investors. These strategies require extensive capital reserves, high risk tolerance, long time horizons, and sophisticated understanding of political and economic dynamics. The goal isn't to predict specific outcomes, but to position for multiple scenarios while maintaining downside protection. This approach has generated extraordinary returns throughout my career, but it has also required accepting substantial volatility and occasional significant losses. Political transitions are ultimately about human nature, social dynamics, and economic incentives rather than just policy details or news headlines. Those who understand these deeper patterns and maintain discipline during periods of maximum uncertainty often find that crisis creates opportunity rather than just risk.